You are now a farmer in ancient England. 1,000 years ago, no banks, no paper money, no investment accounts. The measure of your wealth, the thing that tells every person in your village exactly how rich or how poor you are, is standing in the field behind your house right now. Your animals, your cattle, your sheep, your pigs, your horses, this living, breathing, walking collection of animals is what your community calls your stock, not a number on a screen, not a balance in an account. Your stock is physical, visible, alive, and grazing. Your neighbor can look over your fence and read your net worth in a single glance just by counting the animals on the other side. And here is where a word that sits at the very center of modern finance begins its journey. The Old English word stock originally referred to the trunk of a tree, the main solid foundational part that everything else grew from. Over centuries, it expanded its meaning to describe the main source of a farmer's wealth, his livestock, his stock. And then, as human commerce evolved and grew more complex, the word traveled from the farmyard into the marketplace, from the marketplace into the counting house, and eventually from the counting house into the global financial system, where today it means a share of ownership in a company worth billions of dollars. The same word, 3,000 years of evolution, from animals in a field to Apple, Amazon, and Tesla on a trading screen. But before we get to screens and trading platforms, you need to know something about ancient Rome that almost no financial history book bothers to mention, even though it changes everything about how you understand the stock market. Around 200 years before the birth of Christ, the Roman government needed to outsource enormous public projects, building roads, supplying armies, collecting taxes across a vast empire. Individual contractors could not handle projects this large alone. They needed to pool resources. So groups of private businessmen formed what Roman law called societates publicanorum, companies of public contractors. These companies were too large and too complex to be owned by any single person, so they divided ownership into portions called partes, shares, and sold those portions to multiple investors who each owned a piece of the company and shared in its profits proportionally to how many partes they held. The Roman statesman and philosopher Cicero, writing in the 1st century BC, actually mentions people gathering in the Roman Forum to trade these partes among themselves, prices rising and falling based on how well the contracts were going, investors selling their shares to other investors, profits being distributed to shareholders. You are reading about the first stock market in human history, not Amsterdam, not London, not Wall Street, the Roman Forum 2,000 years ago. Under the same sky where senators debated law and gladiators were auctioned, Roman citizens were trading shares in public companies the way modern investors trade on a smartphone app during their lunch break. Now move forward to 1602. You are in Amsterdam, the wealthiest and most commercially sophisticated city on the planet at this moment in history. A company has just been formed that is unlike anything the world has ever seen. The Dutch East India Company, known by its Dutch initials VOC, has been granted a monopoly by the Dutch government on all trade routes to Asia. The VOC is not simply a business, it is effectively a sovereign power. It has its own army, its own navy. It can negotiate treaties with foreign governments, declare war, imprison people, and govern territories in the name of the Dutch Republic. It is the most powerful commercial entity in human history, and it needs money, more money than any individual, any family, or any government can provide on its own. So the VOC does something that has never been done before at this scale. It opens up ownership of the company to the general public. Ordinary Dutch citizens, merchants, craftsmen, teachers, widows, farmers can buy shares in the VOC and become part owners of the most powerful company in the world. The Amsterdam Stock Exchange, established in 1602, becomes the world's first true stock market, a formal, organized place where people can buy and sell these shares freely, with prices moving constantly based on supply and demand, news from trade routes, and the general mood of investors. For the first time in history, ordinary people can participate in the profits of a massive commercial enterprise without physically being part of it. You could own a piece of the VOC without ever setting foot on a trading ship. And then, less than 40 years later, comes the event that proves something terrifying and timeless about human beings and money. Something that will sound completely unbelievable until you check it against history and realize it is absolutely true. In 1636 and 1637, the Netherlands was gripped by what historians call Tulip Mania. Tulip bulbs, the underground roots of a flowering plant that had only recently arrived in Europe from the Ottoman Empire, became the most speculative investment in the world. Their unusual and exotic appearance made them fashionable among the wealthy Dutch upper class, and that demand drove their prices upward. And then investors noticed the prices rising and began buying not to plant tulips but to sell them later at a profit. Prices rose faster, more investors piled in, prices rose faster still. At the peak of Tulip Mania, a single tulip bulb of a rare variety was worth more than a skilled craftsman earned in an entire year. Some single bulbs traded for amounts equivalent to the price of a complete house on a canal in Amsterdam. People were selling their homes, their businesses, their land, converting everything they owned into tulip bulbs because the price was going up and everyone assumed it would keep going up forever. In February 1637, the market collapsed in a matter of days. Prices fell by over 90% almost overnight. People who had mortgaged their homes to buy tulip bulbs at peak prices were left with flowers worth almost nothing and debts worth everything. Families were financially destroyed. Fortunes built over generations were erased in a week. Tulip Mania was the world's first recorded speculative investment bubble and crash. It happened in 1637, and every single element of it, the irrational price rises, the crowd psychology, the assumption that prices would never fall, the catastrophic collapse, has been repeated in financial markets again and again across the 4 centuries since then, including in your lifetime, including possibly in your own investment decisions. You are back in the present, and if you have ever looked at a stock market chart, the jagged line moving up and down across your phone screen, and felt a combination of fascination, confusion, and a quiet fear that you are missing something that other people understand and you do not, that feeling is not ignorance. That feeling is the entirely rational response of a person who was never properly taught what they are actually looking at. So let us fix that right now. A stock is simply a small piece of ownership in a company. When you buy one share of a company's stock, you become one of that company's owners. A tiny owner, one among possibly millions, but an owner nonetheless. If the company grows, becomes more profitable, and becomes more valuable over time, your piece of it becomes worth more than you paid for it. If the company shrinks, loses money, or fails, your piece becomes worth less. That is the entire concept. Ownership proportional to how many shares you hold, proportional to how the company performs. Now here is a myth that destroys more ordinary investors than any other single belief in personal finance. Most people think that investing in stocks successfully requires the ability to pick the right individual companies, to look at thousands of businesses, identify the ones that will grow, buy the shares before they rise, and sell them before they fall. This belief that successful investing is about stock picking is responsible for the majority of ordinary investors losing money in the stock market despite the market itself going up consistently over long periods of time. The research on this is overwhelming and it is not even close. studies tracking the performance of professional fund managers, people who do nothing all day except analyze companies and pick stocks for a living, consistently show that between 80 and 90% of them fail to outperform a simple index fund over a 10-year period. Not amateur investors, professionals, people with advanced degrees, teams of analysts, access to information that ordinary investors never see, and still more than 8 out of 10 of them cannot beat the simple strategy of buying a small piece of everything. An index fund does exactly that. Instead of picking individual companies, an index fund buys tiny pieces of every company in a broad market index, such as the 500 largest companies in America. When the overall market grows, your index fund grows with it. When individual companies within it fail, the other companies carry the weight. You are not betting on one tulip bulb. You are the entire tulip market, and the entire market across any 30-year period in modern American history has gone up through wars, through recessions, through crashes, through pandemics, through political chaos. Up. Always, eventually up. John Bogle, the founder of Vanguard and the man who invented the index fund for ordinary investors, once said that the stock market is a giant distraction from the business of investing. What he meant was that the daily noise, the prices rising and falling, the news headlines, the predictions, the panic, distracts ordinary people from the simple, boring, extraordinarily powerful act of buying a broad index regularly, holding it for decades, and letting compound growth do the work that stock pickers spend their entire careers failing to replicate. And here is the final thing I want you to take away from this, because it directly addresses one of the most damaging lies about stock market investing that keeps ordinary people out of the game entirely. You do not need to be wealthy to invest in stocks. You do not need thousands of dollars sitting idle before you begin. Modern investment platforms allow you to buy fractional shares, meaning you can own a piece of a company for as little as $1. $5 a week invested consistently into a broad index fund from the age of 25 will, by the time you reach 65, grow into something that most people would need to work an entire career to accumulate. Not because of stock picking genius, not because of market timing, because of time, consistency, and the same compound growth that the Dutch VOC shareholders of 1602 discovered when they stopped trying to predict which trade ship would return safely and simply bought ownership of the whole company. The word stock started in a farmer's field, measuring wealth in living animals anyone could count. It moved to the Roman Forum, where citizens traded shares in government contracts. It arrived in Amsterdam, where a spice trading company opened ownership of the most powerful business in history to ordinary people. It crashed spectacularly over a flower, and today it sits on a screen in your pocket, accessible, democratic, and available to anyone willing to understand it rather than fear it. The Dutch farmer who bought VOC shares in 1602 could not have imagined what the concept would become, but the principle he was following is identical to what every successful long-term investor follows today. Own a piece of something real, hold it through the noise, let time do what panic never can. Subscribe to Money Through the Ages, because next time we are pulling back the curtain on another financial word so deeply embedded in your daily life that you have stopped noticing it, and its ancient origin will shock you all over again.